Anyway, this is Peter,
This is Eliu.
and you're listening to Pineapple Chunks.
Oh, we just sounded so dead there. Let's do it again. What's your name?
My name's Peter,
And I'm Eliu.
and just be sure to like and subscribe the video. If we get to 10 likes, we will shave my head, right? Or should we do 100 likes? 10 likes.
No, let's do 10 likes. I really want to shave your head.
Okay. But don't forget to like, subscribe. We're going to be talking about private equity and Blackstone's recent, they're all over the place. I mean, they control a third of the United States' working people's
Wait. First of all,
retirement money.
Blackstone is a asset management company. For those of you who don't know. And for those of you who think that they're the same as Blackstone or Blackrock. Blackrock is
Another
strictly
private asset management company.
They are not as diversified as Blackstone. So today is going to be specifically about Blackstone, not Blackrock.
Yes. So let's get into it. Alrighty. So the reason we're talking about private equity is one of the biggest. It's literally in our description. I don't think we talk about it enough.
No, we don't.
I'm sure you all would disagree, but I disagree with you. So let's get to it. So private equity, in a sense, just boilerplate, is similar to venture capital, and where a fund borrows money to buy existing businesses, and ultimately, they leverage 2 to 1. So basically, for every profit they make, they leverage 2 times debt, because their belief is that if they shove a ton of debt, which is basically money, into a company that exists and is profitable, they can make it more efficient and then go to the next one, buy more companies and whatever. So that's what private equity does.
So if you have a lemonade stand and it's showing a lot of growth and profits, then a private equity firm would come in and offer to buy you out, putting themselves into debt and making sure that your business runs more smoothly and is able to grow more exponentially, such as maybe adding a new product to your lemonade stand, like ginger tonics or whatever, right? Is that kind of...
It'd be similar, because it takes money to make new products, hire new management teams. Typically, private equity funds, they buy the company and then they get rid of the management team and they hire a new CEO and whatever. And they only keep some people, or they fire the staff, whatever it is.
Kind of like a virus, but like doing good for it's like if a virus made your body stronger instead of weakening it and killing you.
Well, what's interesting about Blackstone in particular is that they are a private equity company. And what private equity is just it's a private company, meaning that it's not publicly traded. Like, people like us can't invest in that. You have to be an accredited investor. And being an accredited investor takes making $250,000 or so a year and having assets of like $3 million plus. So in order for you to invest in companies like that, you'd have to have that amount of money. At least legally, that's what they say. But nonetheless, Blackstone has a stock ticker on the public markets as a security.
So you can invest in a public company that deals with private companies.
So let me just pull up the Blackstone
That makes
ticker.
sense.
Exactly. So Blackstone deals in alternative investments. They own real estate.
A lot of it.
A lot of real estate. They are one of the largest holders of warehouses and distribution centers in the world. They're also a company that their holdings in companies, they have like 35,000 companies, and that accounts for 5% of the United States GDP.
It's a lot. They cover a lot of stuff. I mean, if you're getting Amazon packages, odds are that the warehouse that they're coming from is owned by Blackstone.
Yeah, so Blackstone ticker BX. Right now it's trading at $54.72, which is quite a bargain. And then we have Blackrock, which I know we said we weren't going to bring up, but I just want to know the ticker real quick. And so Blackstone also bought Bumble. They own Bumble. And they also they buy companies left and right. They also have a large holding. Like, aside from the commercial assets, they also own a lot of multifamily, single-family homes.
Yeah, it's a bunch of random stuff. I know Ancestry.com was bought by them, and Oatly, like the oat milk company. You've probably seen oat milk products in stores.
It's just like they're all over the place. They're buying quality investments that ultimately have so much intrinsic value and speculative growth value as well. So, and that also brings us to investing into companies like this, because the stock market right now, the valuations of companies are fairly high. And when valuations of companies are high, the coming years' returns are going to be fairly low, because it's just kind of trade sideways in a way, because it's like you're just kind of slowly growing, and the returns are just not going to be as substantial as years prior to the massive growth rate that we had, 2016 to 2020, before the virus. But not now, we're skyrocketing. So ultimately, alternative investments like private equity, buying existing businesses, leveraging debt at extremely low interest rates, mind you, because money is very cheap right now. Interest rates are record lows. So private equity funds like Blackrock have the opportunity and benefit of using that debt 2-to-1 and leveraging that money to make existing businesses more profitable.
So there's more comfort into getting into debt because of how low the interest rates are right now, right?
Precisely.
Yeah.
And ultimately, they just refinance every time the debt, the interest rates get lower.
It's like if I have a credit card that normally charges me 22% interest rates monthly, and it all of a sudden goes down to 5% interest rate monthly, I'm going to splurge. Going to splurge. I don't mind going into debt because I can just pay that off really easily.
And that level of expediency, as far as efficiency in a business, making profitability, leveraging debt, creates growth at an excellent rate. Mm-hmm. It's the returns are substantial. I believe it was around 15% returns they have average, like private equity, specifically Blackstone Group. They have
annually.
Per year. It's the average yearly return.
And the
for
stock
Blackstone
market,
Group. We should fact check that though. Yeah, what is the average annual return for Blackstone Group? So Blackstone Group, you're probably wondering, it's like, how does it?
9.3% in 2019.
9.3%. Okay. Total returns of 31.5%. Behind the S&P 500's total return. So they underperformed. Is that what it's saying?
Yeah.
Blackstone. Barron's.com. Let's see. That's January 30th, 2020.
Well, here
we're looking at the average yearly return, or ultimately.
So, I mean, traditionally it was...
That doesn't say the average yearly return. That's a gross returns. Like the average... I forget the term. Man.
ROI.
Well, when you invest in the S&P 500, you're expecting an average yearly return. Yeah, the average yearly return of, I believe the S&P is like 9%. The average yearly return.
No, it's the same. Yeah, no, it's 9.3% in 2019. But in 2018, they actually did 19.1%, as opposed to the S&P, which was a negative 4.4%.
So that's another thing about the life cycle of like private equity as well. It's a very elongated life cycle. So like the fund life of a private equity fund is like 5 to 7 years typically. So investors have their money locked up for 5 to 7 years, working for them with debt too, leveraged efficiently, because they have expertise, limited partners. Ultimately, the investors, they bring connections, information, talent, whatever, and they build the company. And so over a 5-year period, a little blip like the coronavirus is nothing, and essentially, especially if you're so diversified like Blackstone Group. And this is why they have so much of America's working classes pension funds.
Yeah, that's right. They play a lot with our retirement money. Believe it or not, that's kind of one of their largest.
They have like $1.75 trillion of cash,
and they're just able to play around with that. Which, I mean, as credible as they are, it's not necessarily a bad thing. They make up for it. They show annual returns, right? It'd be bad if they were showing negative annual returns, but they never really do that. So it's okay that they're playing with our retirement money, and it's also interesting.
One 1.5 trillion. My bad.
And I think it's interesting because they're starting to add portions of private companies into retirement pension funds now. Like they're adding retirement funds into private companies, which is
that was made legal in the 70s or 80s.
But aren't like the common folk going to be able to indirectly buy into private companies from now on? Like,
yeah, you buy Blackstone stock.
Oh, okay.
That's what you do. I mean, so Blackstone has been asking Congress or whoever, funds have to go to ask for more money from the working classes, people from the working class of America. They're like saying, we need more commitment from, their pension fund. Right now they make up a third of their fund of their assets under management, and they're requesting more. Because they can produce returns, so it's, it is a net positive. I mean, honestly, when you provide, what is the number? It's like 35,000. They own 35,000 companies. They employ more than 8.8 million Americans.
It's a lot of people.
That's such a positive thing. Them coming out and being like, look, we want to continue this and grow quickly, especially right now. But only those things can occur if we have a vaccine and people decide to take the vaccine and it works, and but either way we're gonna come back. I mean,
yeah.
I mean our fund life cycle. I mean, we have our own investment funds and we invest in things, and our funds are life cycle are 5-7 years out because we have the time as well. But these investors also are key to driving that kind of growth if you have the ability to do that, and that's really a fantastic ability because you don't have to worry about the daily dips and the whatever's trending at that month or year.
Stress free.
Really much more stress free, but I mean,
just forget about it. You put your money in it and you forget about it.
So listen to this. In 2018, pension funds in the US and the UK pumped 27% of their fresh allocations of money into private equity funds, up from 25% the year before. So they're just continuously adding more, and they're asking, they were like, hey, we need private equity, we need more of it. We create jobs indirectly. I mean, and the reason that their valuations are high and they're able to leverage so much money in these companies, they're buying billions of dollars worth, is because they're not as volatile. The volume that these companies are traded is affects the price, so ultimately the less frequent a company is traded, the more valuable it is ultimately based on the last person who paid for it. So if he bought 100,000 shares of my company for $1 million, and ultimately that leads to the valuation metric. So whatever X metric, you have a 10x multiple, or maybe you have a 5x multiple depending on your industry. But, ultimately, then maybe he might want to sell his shares later. My company probably does something amazing. He sells it for $2 million. Now the valuation of my company just went up, and he just sold his shares and he made $1 million profit, 100%.
Banger.
So ultimately, but that's the infrequency, and you're not tracking it all the time. The stock market, the public market, allows everybody to have the same information. There are rules to actually make that so everybody can have access to the same information.
It's very, very fair.
It's typically pretty fair. Yeah. But you don't know what's going on in the upper echelons of society.
We don't have to talk about that.
Yeah, right? The 1%.
Yeah.
Anyway, so that's what private equity is so far. There's some interesting aspects about private equity and venture capital. There's a big difference between the two. Do you know the difference?
Can you repeat the question?
Between venture capital and private equity, do you know the difference?
Well, venture capital is actually, I thought they were the same thing.
Well, they're similar, but they're different. And the reason that they're similar and different is because they both provide money to companies, but they provide money to companies at different stage of the company's life cycle. Private equity invests in existing businesses that are already cash flow positive, or just, maybe have too much debt and they want to sell. Venture capital funds businesses that are startups, companies that have a bright future, a vision, and those fund life cycles are around roughly the same, maybe 5 to 7, probably a little bit more, maybe 7 years.
Also, doesn't private equity kind of like override the entire management of a company? Whereas in venture capital, it's like it's more consulting, but mainly it's just like, here's some money, do what you want with this money, but just bringing you back returns.
It depends how smart money, how like what kind of money it is. Like if it's smart money or dumb money, like an angel investor isn't necessarily gonna add as much value as like a Sequoia, which is like a huge venture capital fund. Also acts as like a private equity fund as well, because they can buy businesses too. So it depends on the fund size, the assets under management, and the level of connections and expertise the investors have. And that's why you see people like the CEO of Chewy investing in GameStop or in Apple and stocks. Like he's a billionaire now.
Chewy the pet?
Chewy is like it's like the Amazon pet store. It's like blown up huge. So the CEO is just like invested a ton of money into GameStop, Apple, and like some other company I forgot, maybe Shopify. But he's and ultimately like you see people do this, and that's ultimately the way. You see, like
it's not.
But this guy from Chewy, he knows what he's doing because he's already he's started a company. He raised the funds. He's done the due diligence. He's done the legal things. He knows what it takes to do it to do it the right way. He can advise startups very well. I mean, in this sense, right now what he's doing with GameStop, he's buying like a substantial amount of shares, which is interesting, and he's trying to he's forcing them to go more digital and like leverage their like used CDs. Stuff. I'm probably getting really granular right now.
I mean, they also partnered up with Microsoft. So.
GameStop?
Yeah, and Microsoft is diving deep into video games right now.
I didn't know that.
Yeah.
Oh, but the digital video games.
Yeah.
But GameStop is actually he's trying. So the CEO of Chewy, I forget his name, but he's trying to force GameStop to leverage their used CDs, the used video game reselling thing, because that's like their most profitable.
Again with the thrift shops.
Yeah.
Basically.
Yeah, secondhand games. So like they buy the games from people and then they resell it for a profit. But it's like, but that's their most profitable thing. There's the most profitable thing. So he's trying to leverage that and make them do it. Whether it's gonna work or not, I don't know. But he knows what he's had experience. So and he's putting money into it.
Just take my money, man.
So ultimately, that's the difference.
Okay.
With venture capital and private equity.
Right.
So what's something that I've always enjoyed about, a little history about venture capital is the fact that it started back in the day when there was, the Dutch Indian Corporation, like back 1500s, like, yes, like this is back in the day, like when,
like 1940s.
No, like 1500s.
I was way off.
Yeah, 1500s.
Way off.
And what would happen is that like you would have merchants who would hire these ship workers, these people who would travel far distances from England to Africa to Italy to whatever, and transport goods. And what these merchants would do is that these would be like freelance, delivery guys ultimately, and they would split the earnings, the payment, 80-20. And ultimately, the merchant would get 80, and the delivery person would get 20 for delivering the goods. And ultimately, like those were like the first splits as far as like big projects and stuff, and ultimately because it was a very dangerous embarkment, because especially when you were doing ships back in the 1500s, you would run into pirates. Okay, pirates, you might crash into an iceberg. You might sink, and all the goods might be lost, and it could be a complete wash. And but if it's if you do well and you deliver the goods, the merchant has good clients, everybody can win. And that's ultimately the same journey that private equity and venture capital funds go through. And the split that is more granularly, and forgive me for being so specific, the relationship between the people who manage the investments and then the people who invest in the fund and the people who manage investments, the financial advisors. What it's called in private equity or venture capital is a general manager. Mm-hmm. And then the limited partners are the investors. Oh, sorry, the general partner. My bad. The general partner, he manages the day-to-day operations of the fund. And, interestingly enough, they're limited partners because they have a limited role into the investments of the fund and how the outcome of the funds can. So the general partner is mainly in charge of like scouting the deals, raising money, looking for companies to buy.
But it's limited to that, so you can't really. What do you mean? By limiting, they can only use so much that they can't. I don't know what you meant by that.
Well, I'm saying like general partners, for example, have a load of responsibilities from finding. They're basically the stockbroker.
Oh, okay.
So like if you're an investor, you're like, I want substantial returns in private equity and I have some money. Peter, you're a general partner and you're finding companies and you're investing in things that make profitable returns. Here's some money. I have some experience in some fields that you're investing in. Maybe I could help you out later. But here's some money and I know you're gonna do fine. So you give me the money and I go scout out deals but I'm also raising money too. I'm asking people, hey, you should give me money, this and that. And I make money on the assets under management, like a 2% carry. That's like the fee that normally these funds charge. And then I make money on the profits on the 80-20 split, or, it's typically 80-20. But, some funds do a little bit different. But it's not more than, a 5% difference up or down in either direction.
And it's all less risky because there's no pirates.
There's no pirates, but so. There are demanding customers. That's a challenge. Nonetheless, there's just very profitable, as it shows.
Yeah.
And, well, I think that private equity is a positive thing. It's something that, has had a bad rap over the years, but now during the pandemic and ultimately like the level of returns it generates and the lack,
are huge.
Yeah, and the lack thereof of the stock market. That sound.
We have a little bit of ASMR for you guys in this episode. All right. Well, I think we've said a lot.
Let's just like read some stuff now because we can edit this stuff too.
Okay. Can't really read.
Okay. I just don't know if it's probably still recording. Anyway, you want to read this? Read that. I'm gonna zoom into your face so it's like I'm not even in the shop, but just start reading. Okay.
So in venture capital, investors essentially get together to fund risky private companies and make changes to either the management, the strategy, or the capital markets. They do buy a piece of the company to have the right to make these improvements. So the piece of the company that they buy is normally quite large because you have to own quite a good majority of a company in order to
otherwise known as a leveraged buyout.
Yeah, a leveraged buyout.
They leverage debt to buy out a company.
Yeah. It's basically like we're in charge now. We have the money.
Right? But sometimes companies want to sell too. So don't get me wrong. Sometimes companies who want to sell just go directly to Blackstone and look for an offer.
But it's not that bad when you think about, let's say, Amazon and retail and like small companies that are trying to, make a profit, and then Amazon just copies their product and sells it for a lot cheaper, basically running them out of business. At least with venture capital, like you're getting bought out and your company's gonna profit, right?
Yeah, I agree.
So venture capital is not too bad. It's kind of.
And I was making a mistake for the private equity. The median holding time for private equity is 9 years, not 5 to 7. 5 to 7 is a venture capital.
That's a lot of commitment. So for those of you who have commitment issues, maybe private equity is not the best thing for you.
But listen, Blackstone, I own some Blackstone shares and I also own some Blackrock shares, and they've delivered some pretty decent returns over the years for me because if you're a long-term investor, you're benefiting from the substantial returns that they're benefiting from too, and they distribute heavy dividends.
Peter only owns Blackstone stock because stone means Peter in Greek.
It does.
So just
so
you guys know, this is all a facade.
And this pineapple chunks is going to be called Pineapple Stone very soon. We're going to be converting the name just because...
when Peter buys out the majority of the company.
Exactly.
The 80-20 split.
I haven't raised enough debt yet, though.
Stay tuned.
So the dividend yield is 3.4%. 3.4% on per share. So if we do 54.72 times 3.4%, what is that? That's $1.86 a share. And they distribute, I wonder how many times they distribute.
So if you have 100 shares, you
But
get
that's a year.
$18 every quarter? Or
You
every
get
year?
$1.80 a share every year.
Okay, so $100 would
And
give
it's
you
distributed
$18
quarterly,
a year.
for sure. I don't know how, it's probably every quarter. I don't know. Can you look that up, actually? No, you're doing some math. How often? You got it?
Blackstone.
Dividend payment. Payout. I think it's payout. That's the correct way to say it.
Annual dividend. Okay, so it's $18 for every $100.
$1.48 per share. That's not bad. You own 10 shares. I mean, yeah,
It could be better.
I mean, it costs you $500.
Could be a little bit. I want more money.
Dude, but that's not bad.
I want more money.
That's better than a savings account.
Yeah, I mean, anything is better than
Anything is better than the savings account.
At this point in life.
I mean, that's what the system has been made for, though. It's like right now, the system is being rigged by the Fed to ultimately discourage people from saving money. They want you to spend money so they can increase inflation and keep it at that 2 to 3%. And let's just talk about Jerome Powell saying, "Oh, we just want to, we have this, variability. They just want to keep it around that range, which is like we don't even know what the freaking inflation rate is anyway. I mean, it's like what? It's like around 2, 3.
If you have $100,000 in Blackstone, you get $4,000. No, you get $1,400 every year.
If you own $100,000 worth or 100,000 shares?
$100,000 worth.
$100,000 worth of shares.
Oh, never mind. I'm doing really bad math right now.
What is it? 100,000 shares? 100,000 shares.
No, you'd have to have $5,474 to get $1,400 a year.
So you have to have $4.4 million invested to make
5.4.
$5.4 million to make how much a year?
I think
$1,000?
Yeah.
No way.
No, that doesn't sound right.
So multiply that by 3.4%.
3.4%. Oh.
Whoa, you'd make 1.8 million a year with 5.4 million invested in Blackstone.
That's actually not that bad.
Yeah, it's amazing. But Disney or AT&T, AT&T doesn't pay a good dividend. Well, they pay a decent dividend, but they just keep going down the stock price. So anyway, so that's what private equity is. In the gist of it, just let me read this real quick. The pool of U.S. massive funds like venture capital, leveraged buyout, distressed debt, and other related investments fall under the category of private equity and venture capital. Globally, assets under management reached 2.7 trillion in 2010, but it's like way more now. Like this is like an old article that I wrote, but like right now, like the total. Let's see. I think I had it up here. Globally, Blackstone alone is 1.5 trillion, but the industry is just massive. What is the private equity industry like right now? What is the value of the private equity industry? What is the value of the private equity industry? How you doing, bro? You like this podcast?
No, I'm a little bored.
You're not enjoying it?
No.
Man,
I'm a little bored, not gonna lie.
I'm vibing hard to this. I love this stuff.
I was just trying to do some quick maths. You would make this much if you had $1 million.
140,000 with what?
$1 million.
$1 million in Blackstone?
Yeah.
Wow.
Yeah. It's actually not bad.
Not bad at all.
Because you said it was 1.47%.
Depending on the fund size and investment strategy, Depending on the fund size and investment strategy, a private equity firm may seek to exit its investment in 3 to 5 years in order to generate a multiple on invested capital of 2 to 4 times, an internal rate of return of around 20 to 30%. That's damn good. Yeah. That's better than 15%.
That is amazing. That is an amazing return.
That's what I'm saying. So I don't know. Like, the numbers are it depends where you're at. It depends when you invest in, because, man. Yeah. So if you have any companies that you want to start and you need capital, reach out to us. We are angel investors. We are definitely open to investment opportunities, both in real estate and companies. Super open to it. And
got the money.
But at the same time, we're also here to share this info for you to know about, because it's just like, for me, it fascinates me. Ellie, it's a little boring for him, but at the end of the day, investing is investing, and that is just titillating, because you learn so much about various industries. Investing in just hindsight, it's just in general, it's just fantastic. It's just a fantastic thing. So we're just investing in stocks, real estate, private companies.
And art. Or watches.
Art, man. I don't know much about art.
Me neither.
Yeah. But that's private equity for you. Don't forget to like the video. Don't forget to subscribe to the podcast, to the YouTube channel. Follow us on Instagram, on Twitter. We're everywhere. And we're going to start doing some live things. I got like something that we could do some live shows if y'all are interested.
Like the screen sharing stuff.
What do you think, bro?
We're going to be doing some commentaries on just whatever we found on the web that we find interesting. Related, of course, to the stock market and private equity, and it's not going to be completely random stuff.
And remember, 10 likes, shave my head. If I don't get 10 likes, then whatever, I won't shave my head. But it's like, I have a lot of hair up there. It doesn't look like that much, but it's a lot. But I'll shave it.
Take his word for it. It's a lot.
I see. It's like getting puffier. It's like pretty up there. No, don't shave my head. I just want 10 likes. Anyway, bye.
Later.
Hey everyone, Peter here. You just listened to Pineapple Chunks.
Don't be a salad.
If you want to reach out,
be the best goddamn broccoli you could ever be.
More about the show, send me a DM through Instagram. Peter Vivas with 3 S's. PeterVivasSS. Thank you so much, and please tune in to the next episode next week. Pineapple Chunks newsletter and podcast reflect the opinions of only the authors, who are not associated persons of any financial institution. They are meant for informational purposes only and are not intended to serve as recommendation to buy or sell any security in a self-directed exchange account or any other account, and are not an offer or sale of a security. They are also not research reports and are not intended to serve as the basis for any investment decision. Any third-party information provided therein does not reflect the views of Pineapple Chunks LLC or any of their subsidiaries or affiliates. All investments involve risk, and the past performance of a security or financial product does not guarantee future results or returns. Keep in mind that while diversification may help spread risk, it does not assure a profit or protect against loss. There is always the potential of losing money when you invest in securities or other financial products. Investors should consider their investment objectives and risk carefully before investing. The price of a given security may increase or decrease based on market conditions, and customers may lose money, including their original investment. Pineapple Chunks LLC is not a member of FINRA, SIPC, or the SEC.